Let me ask you a question. If you left your money sitting in the bank for the next 10 years, would it grow or would it shrink? Here's the shocking truth. If you only save and never invest, your money actually loses value over time. In 2010, 8,000 naira in Nigeria could buy you a full bag of rice. Today, that same bag costs over 40,000 naira. In the US back in 2010, $2.50 could buy a gallon of milk. Today, it's closer to $4.50. This is inflation. It's like a silent thief, slowly stealing the value of your money. But here's the good news. While inflation eats away at savings, investing grows your money. Investing makes your money work for you even when you're asleep. And the earlier you start, the stronger your money grows thanks to the power of compounding. Imagine planting a tree. The earlier you plant it, the more time it has to grow and bear fruit. So in this video, I'll show you why you should invest with real-world examples, where you can invest with pros, cons, tips, and examples, how to start investing step by step, even with small amounts, and the biggest mistakes to avoid. By the end, you'll know exactly how to make your money grow, no matter your income level. Let's get started. Here's the truth. If you don't invest, you lose money over time. Let's start with Nigeria. In 2010, 100,000 naira could pay a year's rent in some areas of Lagos. Today, that same 100,000 naira might not even cover 1 month's rent. But what if you invested that money instead? In Nigeria, 100,000 naira invested in Dangote cement stock in 2010 would be worth over 500,000 naira today. That's the difference between saving and investing. Saving keeps your money safe, but investing multiplies it. The lesson is simple. You can't save your way to wealth. You must invest your way there. Now let's look at different places you can invest. I'll share examples, pros, cons, and tips for each. First up, stocks. Stocks are shares of ownership in a company. When you buy a stock, you essentially own a small piece of that company. Stocks represent a claim on the company's assets and earnings. For example, $1,000 in Apple stock in 2010 is over $10,000 today. Likewise, 100,000 naira in GT Bank shares in 2010 is around 450,000 naira today, plus dividends. The advantages are high growth, potential dividends, and it's easy to buy/sell. The disadvantages are that prices can drop suddenly and it requires a lot of patience, which a lot of people don't quite have. Be sure to start with companies you know and understand, like banks, telecoms, or tech. Second, bonds. Bonds are a type of loan that you give to a company, government, or organization. When you buy a bond, you are lending money to the issuer, and in return, they promise to pay you interest plus the original amount, that's the principal, when the bond matures. For example, Nigerian government bonds pay around 12 to 14% annually. 200,000 naira invested will amount to 24,000 to 28,000 naira yearly, with you having 224,000 to 228,000 at the end of the year. Although US Treasury bonds pay less, about 4 to 5%, but are extremely safe. Advantages: it's safer and has predictable income. Unfortunately, you get low returns and it has a long lock-in duration. This type of investment is good for conservative investors and short-term goals. Third, mutual funds and ETFs. Mutual funds let many investors pool their money so professionals can invest in a diverse mix of stocks, bonds, and other assets, while ETFs are similar collections that can be bought and sold on the stock market like regular stocks, offering flexibility and diversification. Example, $100 monthly into an S&P 500 ETF for 10 years equals to over $20,000 today, even though you only invested $12,000. Likewise, funds like Arm Discovery Fund in Nigeria allow beginners to invest in a mix of stocks and bonds. Luckily, it's diversified, managed by professionals, and beginner-friendly. But while some may charge fees, others may not all perform equally well. This is best for beginners who want growth without stock picking. 4. Real estate. Real estate as an investment is buying property, like land, houses, or commercial buildings, with the goal of earning money through rent, resale, or property value appreciation over time. A 1 million naira plot in Ibeju Lekki in 2010 is worth over 30 million naira today. Similarly, the price of homes bought in the US in 2010 doubled or tripled by 2020. These forms of investments are tangible and give rental income. The problem is that it requires large capital. It's not easy to sell fast and there's a risk of scams. So be sure to always verify documents and buy from trusted sources. Fifth, Treasury bills and fixed deposits. Treasury bills let you lend money to the government for a short period and earn a safe return, while fixed deposits let you lock money in a bank at a fixed interest rate for guaranteed earnings. These are very safe because it's backed by the government and it offers steady returns, although they're low returns compared to stocks or real estate. This is best for low-risk investors who prefer stability. The golden rule: diversify. Don't put all your money in one place. A mix of safe and growth investments gives you balance. Now that you know why and where to invest, let's talk about how to actually start. Here's a step-by-step roadmap you can follow. Step 1. Define your goal. Ask yourself, why am I investing? For retirement, a house, or just to build wealth? Your goals determine your investment choice. For example, if you're saving for a car in 2 years, use safer options like treasury bills, and for retirement in maybe 30 years, stocks and real estate make more sense as a first choice. Step 2. Build an emergency fund first. Before investing, save at least 3 to 6 months of living expenses in a safe account. If your monthly expenses are 100,000 naira, aim to save 300,000 to 600,000 naira before investing. Step 3. Start small and consistent. Keep in mind that you don't need millions to start. Begin with small amounts regularly. Example, 10,000 naira invested monthly at 10% return could grow to 7 million naira in 30 years. Step 4. Choose the right platform. Use trusted platforms. In Nigeria, you can try Bamboo, Rise or Trove for global stocks and banks for treasury bills. In the US, Vanguard, Fidelity, Robinhood, etc. Step 5. Diversify your portfolio. Spread your money across different assets. Don't keep it concentrated in one investment. For example, with 100,000 naira, you can put 40k in stocks, 30k in bonds, and 20k in mutual funds, and 10k in maybe crypto. Step 6. Understand risk versus reward. High returns equals to high risk. Safer options like bonds give steady income, but lower returns. Risky ones like stocks and crypto may bring big profits, but also losses. Step 7. Think long-term and be patient. Investing works best with time. Don't panic when markets drop. 50,000 naira invested at 10% yearly, left untouched for 30 years, grows to 870,000 naira. That's the power of compounding. Follow these 7 steps and you'll be well on your way to financial growth. Before you jump in, let's talk about mistakes that can cost you big. 1. Avoid falling for investment fads or promises of quick riches. Focus on proven strategies and always do your research before putting your money into anything new or trendy. 2. Investing money you can't lose. Never invest what you budgeted for rent or school fees. Use spare money only, because if your rent or school fees money is lost to scams, you'll be left financially stranded. 3. Not diversifying. Putting everything in one stock or asset is dangerous. Spread your risk. 4. Being impatient. Warren Buffett became a billionaire after decades, not months. Patience is wealth. 5. Ignoring fees and taxes. Some apps charge high fees that eat into profits. Always check what you're going into. You should start actually reading terms and conditions, because I'm sure many of us don't. 6. Not having emergency fund. Without savings, you may be forced to sell investments early at a loss. So here's the bottom line. Saving is good for emergencies, but investing is how you build real wealth. Whether you're in Nigeria, the US, or anywhere else, the rules are the same. Start small, stay consistent, diversify, and think long-term. The best time to start was yesterday. The second best time is today. If you found this video helpful, hit the like button, subscribe for more money tips, and tell me in the comments, what's the first investment you like to try? Stocks, real estate, or bonds? Then I can tell you more about it. And remember, don't just work for your money. Make your money work for you.